let's talk about performance. Everybody's favorite subject. When I'm out in public and tell people I'm a portfolio manager, the first thing they want to know before I even shake their hand is, what has your investment performance been? It's a good question because performance is important, but for how important it is, I think it's often misunderstood. This presentation is going to dive into how we should think about performance, what does historic performance look like, how can we think about future performance, what are some of the ways we can be fooled or misled when looking at performance, and what are some of the most interesting things that we've learned at Camber when observing, measuring, and calculating performance. I'm Rob Townsend, the CEO of Camber. Today we're talking about investment performance. When looking at investment performance, the place to start to truly understand it is by looking at the history. Now, historical market performance can be easily misinterpreted, so we want to take a disciplined view of what historic market returns have been. To do this, we're going to look at the Credit Suisse Investment Returns Yearbook. It's done with Credit Suisse, the London School of Business, and Cambridge University professors, meaning it's a real data set that we can trust. It measures 23 countries, they update it every year, and it goes back 120 years, back to 1900. This gives us a very realistic return for what stocks have provided. That number, the real rate of return, has been 5.2%. Now, I don't want you to focus too much on that number because they've backed out inflation. If we make an estimate of inflation over that period of time, let's say 3%, which I think is fair, we get to a nominal or a total rate of return of 8.2% per year. That is the historic number of what stocks have delivered to long-term investors. Now, the reason I say long-term investors is because as investors, we know the stock market does not look like this, a linear rate leading to that 8% average. Instead, stock market returns look much more like this. And I'd like to demonstrate just something that I found quite interesting is this study that Ben Felix has done over just how extreme one-year returns in markets are. This is looking back to 1970, Canada, US, and international data. And what he says is, if we believe normal one-year returns fit in a band of plus 15% to 8%, if that's our definition of normal, then 50% of the time, stock market returns fit into that range of normal. But that means that 50% of the time, stock market one-year returns are either highly negative or highly positive. So when we're looking at stock market returns over 1 year period, we should expect extremes. Now, the past is the past. If you haven't captured that roughly 8% historically, well, then it's gone. So how should we think about future rates of return? Well, I think that 8% gives us a really good base case. But there are arguments to say, look, we can learn a lot from stock market valuations, globalization, and demographic trends in order to form opinion about what that future rate of return will be. Well, fine. I'm going to stick with the 8% number, but the Canadian Pension Plan, actuarial studies, and the Financial Planning Standards of Council Board of Canada have done a study to try and forecast what those future rates of return could be, looking at the historic data, but also incorporating some of those factors like valuation, globalization, and demographics. Their return estimates go forward are 6.45% for stocks and 3.9% for global bonds. Now, what do these numbers mean? It's impossible to understand whether a percentage number is good or bad. We can only understand it really within the context of our own lives, I believe. So what this entails is figuring out how much you have today, how much are you going to save, when are you going to retire, and how much are you going to spend in retirement. And that, combined with a percentage return number, is going to tell you whether those returns are good or bad. So here I've graphed out your life, here's death, and your net worth. So it starts with how much you have today, how much are you saving, then you retire, how much do you spend in retirement. It's only by taking this path and attaching a percentage rate of return to that number that you can understand whether those returns are good or bad. If when you attach that percentage to your situation and you run out of money halfway through your life, well, then those percentage returns for you are bad. If you find that it satisfies all your hopes, goals, dreams, and desires, then I would say that percentage return is good. What I think you'll find if you do the math, and what we find with our clients at Camber, is that when we run anything close to the historic market rates of return, the numbers are off the charts. It's an amazing return. So the stock market returns have been very powerful had you been able to achieve them. And I think go forward, if you're able to achieve them, they will satisfy all of your hopes and dreams and desires. And constructing a market portfolio isn't really that hard. There are only a few ingredients. You start with some Canadian stocks, you add a good portion of US stocks, complement that with other international developed markets, and then a pinch of emerging markets, and you've got a global basket. Historically, had you done that and held it through the bad periods and the good periods, you would have come out with that 8% number. But what I can tell you is that most Canadians do not achieve that market rate of return. In fact, they achieve something much less. And I want to go into some of the key reasons that I think people aren't able to achieve a simple market rate of return. By far, the biggest reason is individuals trying to pick individual stocks or paying someone to try and pick individual stocks on their behalf. Now, I think why this is so attractive is we all have stories of people buying stocks and getting rich off them. So it makes it feel like it's within our grasp. But I don't think they understand just how stacked the probabilities are against you when you try and implement this strategy. There's some really cool research out of the US. It's US data going back to 1929 and looking at US stock performance. And what you can see is that when you measure where the stock performance has come from the US market, which has been a very healthy return, and you try and attribute where that return came from, you find that 58% of stocks, about 26,000 companies since 1926, about 58% of stocks gave you a return that is less than what you would have got in a risk-free investment like a T-bill in the US. 38% of individual stocks did marginally greater than T-bills. And really all the performance came from just these 4% of winning stocks. When you combine this group together, 96% of the stocks in the database had a return that equaled the risk-free rate. That means equaling just owning T-bills. So you really had to have some of those 4% winners in order to get the rate of return that was delivered to US stock market investors. So when you're throwing darts and trying to pick winners, the odds are just so stacked against you. But people do it, and they go about it kind of in three basic ways. The first is they try and do it themselves. And I just want to kind of paint the picture, if you're not a professional investor, of just how hard investing can be. And I think this is so perfectly summed up by a tweet by Morgan Housel, who says, US cigarette consumption has dropped 44% since 1981. Altria stock is up 71,000% since 1981. Investing is hard. For those that don't know, Altria is one of the world's largest producers of and marketers of tobacco. So markets are extremely complex. Markets don't always equal the economy, and stocks don't always equal the trends of their industry. The second way people go about picking winning stocks is by paying a financial advisor to pick them for them. Now, there is no data on this because every financial advisor doesn't have to have a benchmark that they have to compete against. They don't have to have their returns audited. So we don't really know. But it's probably safe to say that your financial advisor that you sit down with is not able to pick winning stocks. That's because the barriers to becoming a financial advisor are really very low. It's not a regulated title. And two, really their job is to build a client base and service that client base. Their job isn't to just spend all day, every day, looking at stocks and bonds and understanding market trends. Their job is really more of a service provider than a professional money manager. Now, there are professional money managers. That's category 3. And if you've met any of these individuals, they are very smart people and they have big teams behind them. Supercomputers, all the numbers you can think of in whatever sector or industry or global market that they're picking stocks in, you will be blown away by their acumen. But when we measure just how well they've done, and we can do this because it is regulated and they do have a benchmark that they have to compete against, we can see what percentage of time they're able to outperform a simple benchmark, meaning what percentage of the time can they pick winners. To do this, let's look at a short video. It's the 2019 Dimensional Study of professional money managers and their ability to outperform benchmarks by picking winning stocks.
Every year, Dimensional analyzes returns of US-based mutual funds to determine how many funds outperform benchmarks after costs. This year's study encompasses thousands of mutual funds invested in US equities, international equities, and fixed income. Let's first look at how equity funds in this sample performed against their respective benchmarks. Over the past 10 years, not all funds survived, and only a small percentage of funds survived and outperformed after costs. And for 15 and 20-year periods, surviving and outperforming funds were also in the minority. We also saw similar results for fixed income funds, where a small percentage of funds survived and outperformed benchmarks. So you might look at these results and say, I'll just pick the funds that outperformed. But do top-ranked funds repeat? Let's turn back the clock 5 years and say we wanted to invest in mutual funds, using past performance as our guide. To pick a fund, we looked at returns over the previous 5-year period and considered only funds that were in the top 25% or top quartile of returns. Then we took those top performers and observed how they performed over the next 5 years. How many of these funds kept their top ranking? We found that only a small percentage of funds in the top quartile stayed on top. We performed this analysis for overlapping 5-year periods over the past 15 years, and found that, on average, the majority of the top-ranked equity funds did not repeat their top ranking, and the number that did repeat was about the same as you'd expect by chance alone. We also saw similar results for fixed income funds, where only a small percentage of the funds repeated their top performance ranking. The research suggests that a fund's past performance is not enough to predict future results.
Okay, so what are the takeaways? It's that your best odds of picking winners is with a professional money manager, but they only deliver 20% of the time. That means 80% of the time in those strategies, you're underperforming. So don't pick stocks, and don't pay people big fees to do it for you. Winning stocks only come from 4% of the market, and even the world's best can't pick them consistently. Your retirement dollars are too valuable, and the market return is already more than enough. So don't take on the risk. The second reason why individuals don't get the global stock market return is because they don't own global stocks. This infographic should show the relative size of each market compared to that of the world market. It shows you that Canada's stock market makes up 3% of the world market, where Australia makes up 2% of the world market. In personal finance, there's something called home bias. This is where we see that individuals living in a country own 80% or more of their assets in that country. So a Canadian investor would have 80% of their money in Canada, and an Australian investor would have 80% of their money in Australia. This is taking on a lot of concentration risk. We need to look at the history of the stock market to understand that Russia's stock market went to zero. China's stock market went to zero. Maybe more telling, Japan in the 1980s was an economic powerhouse. They were a large percentage of the world market, and their stock market return from the 1970s for 20 years went on to double that of what US stock investors achieved. But in 1990s, cracks started to emerge. Their economic system ran into trouble, and they had a market crash that they've never really recovered for, providing almost no rate of return for Japanese investors since the crash. Diversification protects you from that single country risk and increases the probability of you capturing that global market return. In conclusion, historic market returns. Through an academic lens, we can see they're right around 8%. What does the future hold? We don't know. You can anchor to the history, 8%, or look at a Canadian pension plan's actuarial data study, which says it might be closer to 6.5%. But whether these returns are good or bad, All depends on the context of your own lens. Do the math. And the ways to ensure that you don't achieve these returns is by engaging in stock picking or over-concentrating just in your home country. I would like to leave you with one last thought, and that's just that performance tells you a lot, but it is not the whole story. We link performance results to decision quality in investing, but it's easy to see in life where the relationship between decisions and results are not correlated. For example, a drunk driver who gets home safely did not make a quality decision. Investing, it involves incomplete information. You can make the best possible decision and still end up worse off. To understand decision quality, we need to look at broader groups of decisions in order to understand whether those are making a good decision-based process or not. Coming to conclusions on a small set of outcomes is really misinterpreting the data. I want to show you an example that kind of highlights this. An alien comes to Earth, and they have the option to buy 2 stocks. In 2010, they can buy Domino's Pizza stock, or they can buy stock in Warren Buffett's company, Berkshire Hathaway. Now, Warren Buffett has the most impressive track record of any investor in history. He's also one of the richest men in the world. The correct decision is to invest your money with Warren Buffett. However, we can see now that Domino's Pizza stock has actually grossly outperformed that of this professional money manager, the best in the world, Warren Buffett. So what does it tell us? It tells us that unless you were able to predict the future with certainty, which is impossible, Domino's isn't the right decision, but it is the better outcome. So we can't link investing results and decision quality. They just don't line up 100% of the time. I highlight this just to say, don't focus solely on performance. At Camber, we construct portfolios that attempt to capture the global stock market return. We anchor what are good returns based on what's important and needed by the client. We do the math. We diversify globally, and we don't pick individual stocks. That's it. I hope this has been a lens to understand market performance and our investment strategies at Camber.